Liberation Day tariffs, they lead to a pretty substantial loss for the S&P 500 over 2 days of 10.5%. Hey everybody, this is Brant from Wolf on Wall Street Trade and technicaltake.net. We're going to take a look at what's going on, the probabilities, and how we look forward into next week. Selling has been really aggressive. Look at this volume, and the entire market's just been very, very uncertain and very fluid in terms of headlines. In fact, for me, the past few weeks have been pretty relentless as far as work. 12, 15-hour days is the norm. Just trying to keep up with fluid and fast-changing information for my subscribers. So to unwind at night, I don't want to watch the news. I don't want to watch anything like heavy. So me and my significant other kind of turn to light-hearted content, comedy or whatever. And so I was watching Moana the other night, and a line from that hit me pretty hard because it's kind of my market philosophy, how I look at the markets. And the line was about wayfinding, and to know where you're going, you have to know where you have come from. So I think that's very important. And if you go back and look at a lot of my videos from the last 6 months, year, whatever, you'll see a lot of that. So coming into like last July, we lost leadership in the market completely, and that was a big problem. So whether or not, it was Trump or Biden, or doesn't matter, there was a problem in the market coming into the new year. So if we look at the semiconductor index, the SOX index, going back to July, I actually started to suspect, when we're here at new all-time highs, based on 3C charts, based on volume, that this may be a head and shoulders top forming. There's no way of knowing that at this point because we just have a higher high. But as we move forward, my suspicions were proven correct, and we got into this head and shoulders top. And here's the neckline. So if we zoom out just a teeny bit, you can see it there. 3C confirmed it. More importantly, volume confirmed it. Volume is super, super important to confirm a head and shoulders top, or even more so a bottom. And we've had a measured move, downside measured move for this, where we expect it to go for 6 months, pretty much. And that's what we see this week, is a break of that head and shoulders top, heading down towards the measured move. And I always say semiconductors are like the canary in the coal mine for the tech sector. The tech sector is so heavily weighted. It basically is the S&P, or the Magnificent Seven stocks basically are the S&P and the Nasdaq. I view this as a leading indicator. So we know where we're coming from, and that kind of helps explain where we're going now. If we look at the 3C chart of the most important stock in the sector, and as far as semiconductors, AI, Nvidia, you can see 3C like positively divergent into this area late in 2022, coming in 2023 when tech took over leadership. But as we get into that June, July area, you can see 3C negatively diverging in the most important stock, probably for the market right now. And a lot of the negative divergence this summer up till like September over here was at the same time the CEO was selling $713 million of his own Nvidia stock. I think DeepSeek, which I'm not going to get into right now, but I think that was a really important development. Not so much that the company is going to take over market share, but what they achieved with a lot less. And I think that's a really important theme for the semiconductors, for technology, for the Mag 7 stocks, and thus for the broader market. And when I see a 3C chart looking like this in a top leading stock for the market, for the whole AI theme, where tech's going, it's not a good sign. Now, more specifically for 2025, as we came into this year, started seeing a rare price pattern develop in the S&P 500. And this is a 2-hour chart here that I've rolled back a little bit so you can see it. But as we come into the election here, you can see the gap up. What's been happening in the S&P 500 ever since then is a broadening top, which is characterized by higher highs and lower lows. A broadening top is the literal depiction of a chaotic environment that has lost leadership. So think back to Nvidia, semiconductors, mega caps, what happened around July with those. leadership never coming back, and it has to do with a market that is reacting to news and rumors. It's basically a market that is lacking intelligent sponsorship, leadership. If we roll forward, we can see what has happened since then. It was perfect. I mean, it was telling us this is a chaotic environment that does not have leadership and was susceptible to a move like this on the right catalyst. Furthermore, we had resistance in key averages. So the Dow Jones Industrial Average up here around 45,000, or the Nasdaq 100 right up here around 22,100. So this is all just telling us that the market is struggling. It's struggling with leadership, even in the best of times with, positive developments. Then when we dig into my proprietary indicators like 3C, which is underlying money flow, for those of you who know something about it, this is the long-term trend daily chart. So you see confirmation over here, even leading positive signals over here. But as we get into the summer, in this June, July area, negative divergences. As we get into all-time new record highs, even worse. And you can see what we look like now. So underlying money flow looking really bad. Just another sign of buyers lacking conviction. More specifically, as we get into this week and the tariffs or Liberation Day announcement. The S&P 500, this is a 60-minute chart, breaks this trend line, comes down. You might remember our absolute breadth index signals that were popping off right over in this area at all-time new highs, and I did a video on that, what it meant. We got this decline, found a little bit of support in here, right, and have been in this kind of rectangle bouncing pattern, or a bounce up to here, and could either be a W base or a rectangle. It's just a period of uncertainty. It's just like a holding pattern. And other than maybe 1 week somewhere right back in here, we saw a little bit of increase in conviction that led to this, and then we got some tariff news and came back down, and conviction over here has been very, very low. So we have not been seeing the kind of money flows on the short-term basis that suggests traders had any kind of confidence, right? Just in a waiting pattern. And if we take a look at 3C in that area, we can see it. So here's where we got the ABI signals between the 14th and the 20th of February at all-time highs. Negative divergence in 3C, price comes down, 3C confirms. Here's a relative positive divergence, the selling pressure letting up. Here's that range. Okay, over here. And then here you can see where we got some news and price starts to come down, and just not any conviction over here. Not a horrible negative divergence, although there was some end of quarter selling, window dressing in tech. So the worst performing stocks were being sold. But just very low conviction. So I think things could have gone either way, depending on the tariff announcement. I think we could have gotten maybe like a 5% bounce, 6% bounce if we saw a little bit of stability and certainty with the tariff announcement coming out and being not so bad. But that's not what we saw. Looking at S&P futures on that day when President Trump first announced a 10% blanket tariff, the market liked that certainty. We saw some movement to the upside in S&P futures, but then when he came out with the rest of it, the reciprocal part, which was really heavy, you saw the reaction here. So basically, Wall Street consensus was that it was either the worst case scenario or worse than the worst case scenario as far as the reciprocal tariff rates. And this chart shows us why. It's from Deutsche Bank. U.S. tariffs as a percentage of imports are approaching the highest levels since the early 20th century here. That's how much worse the tariffs were, the announcement, than Wall Street consensus. What's really interesting is the uncertainty factor and it looking a lot like a scenario that I described for subscribers on March 18th in the Subscribers Daily Wrap. And that was going back to the 2018 period where the S&P sold off 20%. So this was the post from March 18th, and you can pause it and read it. But I was saying there's a pretty reasonable chance that we get something that looks like this. We had already gotten this and low and started to bounce off that low. The point was that we could get this kind of second leg measured move down. This is a little closer look of what 2018 looked like, and this was really uncertainty around the Fed. The Fed was hiking rates, the market was saying stop, and we saw a sell-off here. We saw this kind of move like this into the December Fed rate decision, and then we saw another second leg down. But what I like to call this is like this lateral range over here, and then we get a test just below it right here, and then what I call a whimper rally or a whimper bounce right here. And here's what we actually got this past week. So the same kind of setup, first leg down, this lateral range, the test right below the low over here undercuts it in a successful test. Kind of a whimper rally bounce. It looks a little bit stronger in price candles, but not on the 3C charts. And now we're starting that second leg down. So here's the first leg down, second leg down. Same scenario as 2018. And again, this is something I outlined for my subscribers back in March, the middle of the month. Okay, so why do I bring this up? Because both situations were based on uncertainty. Now we have a very clear measured move target for the market right now. Like 2018, all of this was caused by uncertainty. So if we go back to the 2018 model, which I have from the post I shared, you can see the first move 10%, then a much bigger second leg down over here. The reason why was uncertainty was not removed at the time. That was the Fed hiking rates, and the market was saying, whoa, you've gone too far. So the market didn't recover until the Fed capitulated on Christmas Eve. We're in a same scenario right now where uncertainty is really high. Markets hate uncertainty. So while we do have a measured move, it could go beyond that because of the uncertainty. So for instance, China just retaliated against the US and hiked tariffs 34%, right? So does President Trump do the same and raise tariffs again? There's a lot of uncertainty, is my point. I'll show you how we're going to deal with that beyond the measured moves. I'm hesitant to give out a measured move over a weekend video because everything changes so quickly, and it depends on what other asset classes do, like semiconductors. It depends on what intraday trade looks like. If we get a consolidation in the middle of the second leg down, it will give us a more accurate target for the rest of the move. And it's subscriber information, so this is what they pay for, the real-time update analysis of what's going on every day as the markets are live. But basically, we have a measured move. I'm just going to go over the S&P 500 of 4,900, but we're pretty much at this halfway point. And a lot of times when we're at the halfway point, like over here, you'll get a small consolidation like that. And we have some indications, very early indications from late Friday, that maybe we're going to see that next week. But it also depends on what other assets do, like semiconductors. Do they continue to get dumped? If they do, it's going to weigh on the tech sector. Tech sector is the most heavily weighted sector. It's going to pull the S&P and the Nasdaq down more. So what I'm saying is usually I have a lot of confidence in price action determining or telling us where it is going. So 4,900 in the S&P as far as measured moves go. But when we're in an environment like this, like that 2018 environment, and the market still doesn't have any kind of certainty, that's when measured moves get exceeded and surpassed. Like with the semiconductor index, we're a little bit past the halfway point of the measured move, so this would be a reasonable time to expect a small consolidation in the middle of this leg down before we head down to the rest of it, which comes from that larger head and shoulders pattern. Now, if we do get that consolidation, what can we do with it? Well, would you have traded this short for, a 21, 22% decline? Maybe with some leverage? Sure. So if we do get a consolidation, that gives us a little better price entry, right? At a little higher price. And it gives us an opportunity to get short, not chasing prices lower, but into a little bit of price strength. Or if you have an existing short, then you can add to it because the trade's already working. The head and shoulders top has already broken down. And if you look at any of the semiconductors or like the SMH ETF, the volume on this break was absolutely enormous, which is exactly what you want to see when a Head and Shoulders neckline breaks. Another really important group of stocks for us to watch are the Magnificent Seven. So I'm just going to use the MAGS ETF, which is the ETF for the Magnificent Seven. You can see the bear flag. You can see we've got the first leg down. We're into the second leg down. It's got a lower measured move on it. These stocks lost $1.4 trillion. These 7 stocks, $1.4 trillion in market cap just this week alone, and something like $4.5 trillion in market cap since they've come off the highs. They're really exposed to a trade war. So they get 49% of their earnings from outside of the US. If you take the other 493 stocks in the S&P 500, that percentage is more like 26%, or the domestically focused, domestically oriented Russell 2000 small caps is more like 21%. So they have a lot of exposure to the trade war. They have a lot of exposure to retaliation. But here too, we're a little bit more than the halfway point of this second leg down. So it would not be an unusual place to see a midpoint consolidation. And that's the same scenario for the S&P 500, which, by the way, also broke this major uptrend line. And it's the same story for the Nasdaq 100. So it's something we're going to be looking for next week. We don't have really strong evidence of that being the averages closed at session lows. If it does happen, this is kind of the area where it tends to happen. And then we can take that measured move and start to really dial in the next leg down. The Nasdaq 100, the Nasdaq Composite, and small cap Russell 2000 are in technical bear markets, so 20% or more off the high. I really look at bear markets in terms of trends, like lower highs, lower lows in the primary trend, but bear markets. I'm not going to get too much into recession odds in this video. That's a whole nother thing. But a lot of the assets that I watch really closely, the leading market signals, so like oil, copper, treasury yields, the Australian dollar, which is a commodity currency. These are what I watch as leading signals, and they've always given me a really good heads up. 5-6 weeks before the COVID crash, they were screaming deflationary recession. 2018, same thing, that move that I just showed you. The late 2015, 2016, just a lot of examples. So they're really good leading market indicators, and we've seen some really ugly action in them. So like WTI crude oil, down 13% from Monday's close on heavy volume. So this is the oil market saying global demand, global recession. It's marking that down. There's a certain percentage I look for, and we're not quite there yet, but we're getting really close, and it tends to precede recessions. Dr. Copper over here, which is down about 16% from the March highs. Heavy volume. Of course, this is an industrial metal used in everything, so it's marking down growth, economic growth. Silver futures down about 12% just in the last 2 days. So gold has industrial uses, but silver has far more. Again, this is what you're kind of seeing, and gold even got knocked down. You can see nowhere near as much as silver, but about 4% in the last 2 days on heavy volume. And this is more of a typical safe haven asset. And I think maybe part of that is like investors needed to raise liquidity, so they were taking some profits from gold. Here's S&P futures and the Australian dollar. It's a commodity currency. You can see it kind of crashing right over here on this tariff announcement. And the S&P and the 10-year yield. So we're seeing a positive correlation between those again. So the market is less worried right now about inflation, and it's more worried about marking down economic growth. And a recession is a great way to kill demand and kind of kill the last vestiges of inflation. I have a feeling that Trump's Treasury Secretary has a little bit of that in mind to try to get long-term yields down, because the Fed can't really control long-term yields very effectively. But this is also a good leading indicator to watch on an intraday basis, because the bond market is just more sophisticated, better informed than the stock market. When you see divergences here, like we did right over here, the bond market was telling us that the stock market was about to make a low over here. You can see it leading it lower over here. So it's worth watching for that reason as well. As far as maybe getting a consolidation next week, of course, anything can change any minute with a tweet from the president or another country retaliating. But the way we stand right now, we're at extremely deep oversold levels. So this is a breadth indicator. You can't see I've hidden it, but it's on the S&P 500. It runs on a scale of 0 to 100, 0 being the most oversold you could possibly be. I set it to show us levels under 1. So like as oversold as you can get, actually under 0.5. We've had a couple back here in 2022's bear market, and we got one as of Friday. So we're extremely, extremely oversold. In a panicky situation, that doesn't always matter, but we're in that kind of area where a consolidation or kind of like a correction would make sense. Or at least let's just say the environment is ripe for that kind of thing. Potential upside catalysts, of course, if the president comes out and walks back tariffs to some degree, or there's some kind of certainty. That's what the market is really craving, is certainty and not the worst case scenario. Usually the first part of April is seasonally weak, but the month from like the 9th on tends to be one of the stronger, like I think the third strongest of the year. Also, we have global liquidity improving. This is the S&P 500. M2 global liquidity with a 10-week lead. So you can see liquidity has improved. That may help the market a little bit. There is hope starting to build or being priced in by investors that the Fed will come in with an inter-meeting emergency rate cut. Now, we heard from Powell on Friday, and he wasn't having that at all. He wasn't even hinting at anything like that. And of course, he's not going to because it would panic the market even more. If we start to see the credit markets crack, they're starting to get a little bit hairy, but nothing too bad yet. If we see the credit markets start to crack, there's like 3 things the Fed's worried about. They have the dual mandate of maximum employment. So if we have a recession, they cut rates. They can't cut rates to deal with a recession right now because they're more worried about inflation than a recession. Inflation is harder to deal with than a recession. But the one thing they're worried more about than even inflation is a breakdown in the plumbing of the monetary system where credit markets explode. Because at that point, no matter what they do, they can't transmit monetary policy through the plumbing of the system if that system breaks down. So if they start seeing credit spreads just absolutely blow out, they could jump in with an intermeeting emergency rate cut. Right now, I don't see that as a high probability, but the market is starting to price that in more so than it has been. Downside risks, of course, that Trump increases tariffs on China by 34% to match their retaliation, which would bring their stacked effective rate, which was 20%, then added 34% in reciprocal. If he matched their retaliation of 34%, that would bring the tariff rate up to 88%, which would be insane. Poor Apple. Obviously, if more countries retaliate or they form some kind of alliance with new trade deals that exclude the U.S., geopolitical risks are still out there. They're not really the top of my watch list as far as that goes. Credit event, of course, systematic failures. And for subscribers, what we're going to be doing is watching those measured moves, if we get a consolidation or not. I think we're at the point now where we'll start to throw the market into this trend channel again. So this is the last time we got the ABI signals over here on the 14th through the 20th of February, telling us the market was going to see a huge spike in volatility. And the trend channel, which on a downtrend is the lowest level of this higher channel on a closing basis, it held basically this entire move lower, stopped out right over here. This is our lateral trend, and now the trend channel is back in effect to the downside. So every day, every hour, pretty much every minute, it locks in more and more gains. It keeps moving down. So we'll probably start using this to manage any kind of short trades anybody has on. So if you need updates on those, just email me at the support email. Like I said in last year's videos, towards the end of last year, this is going to be an interesting year. It's already off to that. The market has been showing us a lot of weakness, and it just needed a catalyst to see this kind of breakdown. So I have a couple of free articles up at Wolf on Wall Street Trade and the technicaltake.net. The links to the websites are in the description of the video. I'll add one more that deals with DeepSeek, but in the last one I kind of dealt with some examples of how crude oil and copper prices and treasury yields and the Australian dollar have showed us in the past where we're moving into either a market crash or a recession. And I'll add some information about DeepSeek. Other than that, I think that will do it. I would appreciate it if you like the video, you give it a thumbs up or share it. Don't forget to enable notifications so you know when my latest videos are out. I'm very, very busy recently, so making this video is pretty much giving up my Saturday. And if you want these insights in real time, every day the market's open, consider subscribing to Wolf on Wall Street Trade, and the link for that will be in the video description. I hope everybody enjoys their weekends, not too stressed out with everything that's going on. I find it's a little bit better just to try to hang back, not panic too much, not overreact too much, but there have been warning signs. We are late in the economic cycle, so this isn't too surprising, and I think the rest of the year is going to get even more interesting. So I'll leave you with that. Enjoy the rest of your weekend.